Welcome to the 7th video in our series on standard costing and variance analysis. At this stage, we have finished all our production variances. Our next major category of variances are the sales variances. As we work through the sales variances, you will notice various differences to our production variances. However, you should also notice some similarities, so make sure you understand what you are doing in the variances, and this will make your journey a lot easier. So what are our learning objectives for this video? As with our previous videos, we first want to be able to identify the different sales variances that we have. We then want to be able to calculate the variances, and we need to be able to identify potential reasons for these variances. As with our last video on fixed overheads, we also need to compare the variances between variable and absorption costing systems. As always, let's recap our main example for the series. Remember to take screenshots of the scenario so you have it readily available. In our scenario, we have a company manufacturing widgets, and the standard cost card is presented. For this video, we'll be focusing on sales. So you will need to take note of the standard selling price, which is given as 200 Rand. In the opening paragraph of this slide, we are given the widget market size of 100,000 units per month, and are told that our company's market share is 10%. This results in the company planning to sell 10,000 widgets in the month of April, and generate total revenue of 2 million Rand for the month. We then see that the actual sales we made were only 9,000 widgets, which was less than what we expected. However, the total market size was 108,000 widgets, which was larger than we anticipated. We also see that our actual selling price was 205 Rand per widget, generating us a total revenue of 1,845,000 Rand. This last slide provides us with no additional information on sales. Let's consider the different types of sales variances we get. Now remember that sales is a completely different category of variances compared to production, so we will have a lot of differences. However, we will still have some similarities, so make sure you watch out for them. So our first variance is our total sales margin variance. Next, we have our sales margin price variance. For this variance, look out for the similarities to our material price, labor rate, and overhead expenditure variances. Next is the sales margin volume variance. The sales margin volume variance can then be broken down into the sales margin mix and sales margin quantity variances. Conceptually, these variances are similar to the materials mix and yield variances we saw earlier in the series. The sales market quantity variance can then be broken down further to the sales market size and sales market share variances. Let's work through the calculations of these variances, assuming a variable costing system as provided in our overall example. Let's start with the easy one, the sales margin price variance. As I've already mentioned, the sales margin price variance is conceptually similar to the material price variance. We want to compare what we should have sold the widgets for to what we actually sold them for. Remember, we budgeted to sell the widgets at 200 Rand per widget. We actually sold them for 205 Rand per widget. Therefore, we sold the widgets for 5 Rand more than we should have. Because we sold them for more, we are receiving more money, and therefore the variance is favorable. Notice that this direction is the opposite for the material price variance. This is because for the material price variance, we were spending money. So if we spend more, it is unfavorable. But for the sales margin price variance, we are receiving money. If we receive more, it is favorable. Now we have the sales price variance per unit sold. To convert this to the total sales price variance, we need to ask if we should use the actual or budgeted sales. As with our materials price variance, we are going to use the actual sales. Therefore, our sales margin price variance is the 5 Rand per widget multiplied by the 9,000 widgets actually sold to arrive at 45,000 Rand favorable. We will not work through a journal entry for any of the sales margin variances because the sales margin variances are typically not recorded in the accounts. Our next variance then is our sales margin volume variance. For this variance, we are comparing how many widgets we should have sold to how many widgets we actually sold. Notice that unlike the production variances, we are not using the flexed budget. Rather, we are directly comparing the original or static budget to the actual. Therefore, the widgets we should have sold would be the budgeted widgets of 10,000. However, we actually sold 9,000 widgets. This means we sold 1,000 less widgets than we should have. Because we sold less, we are worse off and it is unfavorable. Now there's an important question we need to ask when we are calculating the sales margin volume variance. And that is, should we use the selling price, the contribution margin, or the profit margin to calculate the Rand value? Take a few minutes to think about it and see which one you think we should be using. For this question, because the company applies a variable costing system, we will use the contribution margin. This is because the selling price does not include the effects of profits, and the sales margin volume variance needs to reconcile us from the static budget to the flexed budget. Also, we need to use the standard contribution margin so that we don't include cost and selling price inefficiencies. We will consider how an absorption costing system differs later in this video. Okay, so this means that our sales margin volume variance is the 1,000 widgets multiplied by 100 Rand per widget. Now that was the standard contribution per the standard cost card, which then equals a 100,000 Rand unfavorable variance. Now if we quickly go back to the slide where we prepared the flexed budget and calculated the overall variances, we will see that the difference between the flexed budget and the actual result represents our sales margin price variance only. Then if we look at the difference between our static budget profit and our flexed budget profit, we see that the difference is 100,000 Rand unfavorable, which matches our sales margin volume variance. So it's important to note here that our volume variances reconcile our static budget to our flexed budget. Now let's consider the reasons why our sales margin variances have arisen. Remember, our sales margin price variance is favorable, while our sales margin volume variance is unfavorable. Because our sales variances are interlinked, we will consider some of the potential reasons together. Remember, this list is not exhaustive, and you need to analyze the scenario you have been given for specific reasons. Something to remember for the sales variances is that they often arise from external factors beyond our control. So let's begin with some ideas for our variances. We may need to look at the action of our competitors, especially if we are a price taker. If our competitors adjust prices, we may need to change ours accordingly. Changes to the price may then affect the demand for our product, which will consequently affect our volume variance. We also need to consider the action of our suppliers and general changes to our other costs. If our suppliers raise their costs, then we again may need to adjust our selling prices to ensure we recover the costs. Again, changes to the price may change the demand for our product, affecting our volume variance. Alternatively, suppliers could change the quality of the materials they provide us, which may change the quality of our product and affect demand. We also need to consider the current state of the economy and product demand. If we are in a recession, we would expect demand to be lower, especially if we are dealing with a luxury good. And consequently, we may need to reduce our selling price to stimulate sales. Alternatively, if the economy is booming and our product is in demand, we may be able to increase our price. When considering the state of the economy, remember we need to consider if our product is a necessity or a luxury good, as this could affect the price and the volume sold. Now let's break down our sales margin volume variance into the sales market size and share variance. Notice in this example, we only have one product being sold, namely widgets. Therefore, our entire sales margin variance is represented by the sales market quantity variance, and we don't have a sales margin mix variance. We will extend our example soon to calculate these variances, but for now, let's focus on our main example. Now, because our sales market volume variance and sales market quantity variances are equal, the sum of our sales market size and sales market share variances will add up to our sales market volume variance. It is important to note that we can only calculate these two variances when published industry statistics are available. So let's begin with the market size variance. This variance considers how our sales quantity changes because of the change in the overall market size. So we are considering the change from the budgeted market size to the actual market size. Remember from the scenario that our budgeted market size was 100,000 widgets. Our actual market size, however, was 108,000 widgets. Therefore, the market was 8,000 widgets more than we expected, which is favorable, as we would expect to be able to make more sales. However, we don't own the entire market of widgets, so we need to consider our market share. We use our planned market share to remove inefficiencies in our market share, which are captured in the sales market share variance. From this scenario, our planned market share was 10%. Therefore, our market size variance is the 8,000 widgets multiplied by the 10% to reflect the extra portion we should have received, multiplied by the standard contribution of 100 Rand to give us a variance of 80,000 Rand favorable. Now let's calculate our market share variance. This variance considers how our sales quantity changes because of a change in our share of the market. So we are considering the change from the budgeted market share percentage to the actual market share percentage. From the scenario, our budgeted market share was given to us at 10%. Our actual market share wasn't given to us, so we will need to calculate it. We can calculate it by dividing our actual sales of 9,000 widgets by the total market size of 108,000 widgets to give us an actual market share of 8.33%. Therefore, our market share was 1.6667% lower than planned. Because we lost market share, the variance will be unfavorable. We now need to consider what effect this change has on our proportion of the market we own. So we ask ourselves, what was the total market size? As we have already made adjustment from the budgeted market size to the actual market size in our market size variance, which we calculated on the previous slide, for the market share variance, we will use the actual market size of 108,000 widgets. Therefore, our market share variance is the change in our market share of the 1.67% multiplied by the actual market size of 108,000 widgets multiplied by the standard contribution of 100 Rand to give us an unfavorable variance of 180,000 Rand. Now let us summarize the variances we have so far from the bottom up. We just calculated our sales market size and share variances as 80,000 Rand favorable and 180,000 Rand unfavorable respectively. These add up to the sales margin quantity variance, which in this example is the same as the sales margin volume variance. Remember, we only had one product being widgets, so the sales margin mix variance is not applicable. We then calculated our sales margin price variance as 45,000 Rand favorable. Finally, we can calculate the total sales margin variance as the sum of the price and volume variances. Now, this is great for a variable costing system, but what about an absorption costing system? Let us expand our current example and have a look. Now, unlike the differences we saw between variable and absorption costing under our fixed overhead variances, the difference for sales margin variances are very slight. First, we see that the sales margin price difference is identical between absorption and variable costing. The difference therefore lies in our volume variance and all the underlying variances. The difference comes down to one question we asked earlier. When calculating the volume variance, should we use the selling price, the contribution margin, or the gross profit margin? Remember, when we were using the variable costing system, we used the contribution margin. However, the contribution margin is not relevant to an absorption costing system because absorption costing capitalizes the fixed manufacturing overheads to the product cost. Therefore, an absorption costing system uses the gross profit margin to calculate our volume variances. So let's quickly work through an example. We will use the same example that we saw in our previous video on the fixed overhead variances. Remember, in this example, the fixed overhead absorption rate was provided to us as 8 Rand per labor hour. This means we can revise the standard cost card for an absorption costing system. Notice the changes in terminology. We no longer refer to a standard contribution margin, but we now have a standard gross profit margin. I've highlighted the changed terminology in red. Now we can add our fixed overheads of 5 hours at 8 Rand per hour to give us total fixed overheads of 40 Rand. Our standard absorption cost is then 140 Rand, and our standard profit margin is 60 Rand. We will now use the 60 Rand to recalculate all the variances we have previously calculated. Pause this video and give it a try. We will go through the calculations briefly on the next slide. Now remember, the only difference in calculating the volume variances under variable costing and absorption costing is that we use the profit margin rather than the contribution margin. So for our sales margin volume variances, we take the volume difference between the budgeted sales and the actual sales of 1,000 widgets, and instead of multiplying it by the 100 Rand, we multiply it by the gross profit margin of 60 Rand to get 60,000 Rand unfavorable. Because we only had one product, the sales margin mix and quantity variances are not applicable. Remember, the quantity variance and the volume variance are therefore the same. So the next variances of interest are the market size and share variances. For the market size, we take the change in the total market size of 8,000 widgets and multiply by our share of 10% and then multiply by the gross profit margin of 60 Rand instead of the 100 Rand to get a favorable variance of 48,000 Rand. Finally, for the market size variance, we take the change in our market share of 1.6667%, multiply it by the actual market size of 108,000 widgets, and multiply it by the profit margin of 60 Rand to get an unfavorable variance of 108,000 Rand. Now the last two variances we need to look at, which we have avoided so far, are the sales margin mix and quantity variances. The basic concept behind these variances is very similar to our materials mix and yield variances, which we saw in the third video in the series. One key difference is that for the materials mix and yield, the materials must be interchangeable. For the sales mix and quantity, this is not the case. As long as we have more than one product, we can calculate these variances. In our initial example, we had only one product, being widgets. So we will have to once again extend our example to incorporate multiple products. In this extension, we are retaining the same information as our main example, but we will introduce a second product called widget pros. We are then given the budgeted and actual information for our widget pros. Now you will notice in this example that we have only been given our variable cost per unit. So once again, we are dealing with a variable costing system. Remember, the only difference between a variable and absorption costing system for our sales variances is that for the variable costing system, we use our contribution margin, whereas for absorption costing, we use our gross profit margin. So let us begin by drawing up a table like we did for the material mix and yield variances. However, notice this time that we are using the budgeted sales based on the static budget. We then need to represent our actual sales in the budgeted proportions in our middle column. If you refer back to our main example, you should remember that we budgeted to sell 10,000 widgets. The extended information informed us that we had budgeted to sell 4,000 widget pros. This gives us a total budgeted sales of 14,000 units. If we consider the actual information, we actually sold 9,000 widgets and 4,500 widgets pros. This gave us total sales of 13,500 units. Now we need to calculate the middle column. This column shows us the actual sales, but in the budgeted proportion. So the actual sales was 13,500 units. Now we need to split this in the same proportion as the budgeted sales column. If we simplify the budgeted sales column, we see that widgets form 71.43% of our total sales, while widget pros are 28.57%. So our middle column needs to reflect the same ratio. 71.43% for widgets and 28.57% for widget pros. 71.43% of 13,500 is 9,643 units, while 28.57% is 3,857 units. You will notice that I have rounded these off to the nearest whole unit. Remember to always follow the rounding instructions per your scenario. We can therefore see that the difference between the first column and the middle column will represent our quantity variance. The mix has stayed the same at 71.43% for widgets and 28.57% for widget pros, but the total quantity has changed from 14,000 units to 13,500 units. Then, the difference between our middle and last column represents our mix variance. We can see here that the total quantity remains constant at 13,500 units, but the mix changes from 71.43% of widgets and 28.57% of widget pros to 66.66% for widgets and 33.33% for widget pros. So let's calculate our variances for widgets together. You will then have an opportunity to calculate the variances for widget pros on your own. We will start with our quantity variance. Remember, the quantity variance is the difference between the budgeted sales and the actual sales in the budgeted proportions. For widgets, we get a difference of 357 fewer units. Because this is part of the volume variance using a variable costing system, we multiply it by the standard contribution margin of 100 Rand from the cost card in the main example. This gives us an unfavorable variance of 35,700 Rand. It is unfavorable because we sold fewer units than we should have. Next is the widget's mix variance. This time, we take the difference between the actual sales in the budgeted proportion and the actual sales. Here we get a difference of 643 units. Again, because this is part of the volume variance in a variable costing system, we multiply it by the standard contribution of 100 Rand per unit. This will give us an unfavorable variance of 64,300 Rand. It is unfavorable because widgets' proportion in the sales mix was lower than it should have been, meaning we sold fewer widgets than we should have. Now pause the video and try it for widget pros. Great, so for the quantity variance we get 20,020 Rand unfavorable, and for the mix variance we get 90,020 Rand favorable. Now something interesting to notice is that the quantity variances will always work in the same direction. They will either all be favorable or all be unfavorable. However, for the mix variances, at least one will always be in the opposite direction to the others. So you will notice here, widgets is unfavorable, but the widget pros is in the opposite direction and is favorable. That brings us to the end of our video on sales variances. In our next video, we will complete our example by reconciling our profits. We will also discuss the concept of planning and operating variances, when to investigate variances, and some basics around auditing of standard costing. See you next time.